Good evening to everyone. I'm Ikai from FSM Global. Welcome to this evening webinar, Investing Through the Fog of War. 2026 thus far is far more exciting than a roller coaster ride. On a global level, we got a Middle East conflict, sending the whole world into an energy crisis. On a national level, China's focus on AI for the next 5 years is sending a major signal to the dominant US players. Amid all these headwinds, we want to hunker down and seek stability and income as we wait out the storm. This evening, I'm very privileged to have James Chua, associate from the wholesale client group of Aberdeen Investments, with me. James will touch on why seeking income is one of Aberdeen's key approaches for 2026 and how it can help investors capture resilient returns while navigating uncertainty with confidence. Along the way, if you have any questions, feel free to put them into the Q&A box below, and James will get to them at the end of his presentation. Due to time constraint, I have to apologize first if you are unable to answer all the questions, and we seek your understanding in this. Without further ado, let me pass over to James to start the webinar going. James, please.
Hi, good evening, everyone, and thank you, Ikai. Thank you, everyone, once again for joining us this evening. I see there are still people trickling in, but I think for the interest of everybody who has joined on time as well, let me begin. My name is James, and I'm from Aberdeen. And I think most people would have heard of Aberdeen. And if you have not, no issue. Aberdeen, we are a global specialist asset manager, and we are known for our expertise in credit, specialist equities, as well as real assets. We manage a range of solutions from global fixed income, equities, multi-asset alternatives, real estate, so on and so forth. And as of end of December, we actually manage over 500 billion in assets, and we are located in over 25 locations around the world. Particularly for Singapore, we have been here for over 30 years, and so we actually know the markets, and we are actually familiar with this location as well. Across the globe, we also have over 600 investment professionals, and we serve, of course, both institutional as well as wholesale clients. Okay, so today for my sharing, I will have 3 parts. Firstly, I'll go through a little bit of Aberdeen's house view, our key thoughts for 2026, our approach for 2026, how do we invest through the fog of war, and lastly, I'll introduce one of our funds, our flagship global equity fund, the Aberdeen Global Dynamic Dividend Fund. So without further ado, Ikai has mentioned today that it is really a roller coaster for 2026. Today's environment can be described really as a fog of war environment, where really clarity is quite hard to be gained. So markets really are no longer driven by any single economic cycle. Instead, they are being shaped by global geopolitical conflict, policy uncertainty, and rapid technological changes all at the same time. So in this environment, we think that clarity comes not from predicting or reacting to every headline that you see every day, but from focusing on what we think are the forces that truly matter. So today I want to frame this outlook around 2 key themes without overburdening anyone that are shaping today's markets and how portfolios should be shaped. So the first theme that we will look at is, as I've mentioned, geopolitical conflict, that today is going to be structurally inflationary and not just a short-term market shock. Why is this so? We see this clearly across conflict, the Iran conflict, which is top of everybody's mind, what we saw earlier in past couple of years, the Ukraine war, which is still ongoing, but has faded somewhat to the background. And of course, it started mostly because of the US national agenda, which focused on reshoring and strategic self-sufficiency, right? That started with tariffs, went on to asking allies to do more into their defense spending. And so actually what we saw from the Ukraine war and Middle East tensions have seen defense spending, reshoring, and energy security firmly at the center of many governments' policy. And so unlike past episodes, these conflicts do not and will not fade in weeks, right? An oil shock today is more likely to last months due to damage to shipping routes, threats to production facilities, and higher transport costs. One of the examples that you will give is that damage to some of the Qatari ports will take at least 3 to 5 years before they regain functionality. And so that's what we see as it's going to be a result. It's going to be energy-driven inflation, not necessarily runaway inflation, but definitely some form of energy-driven inflation. So this is enough to keep central banks cautious and restrictive for longer. And what does that mean? That actually helps to explain why markets, we are pricing in only one US Federal Reserve cut in the second half of 2026. So most estimates have cut their rate estimates from 2 to probably 1. And so while US growth remains solid, estimated at about 2% for 2026, mainly due to AI-related capital expenditure, fiscal stimulus, and some fading of tariff uncertainties, we still believe we should keep an eye on inflation as it still remains above the 2% target, and that will play into how many rate cuts that we will see for the year of 2026. I think one of the implications is also that many people will be interested in is what is the implication for the US dollar. So this geopolitical backdrop really matters as well. The US dollar is traditionally seen as a strength or a safe hedge, but these pillars are actually weakening at the margin. It's not overnight, but it is structurally diminishing. Why? There's a lot of concerns over their fiscal discipline in terms of government spending and their trade deficits, where there are imports against exports, and as well as a gradual diversification away from the US dollar, which especially against emerging markets currencies. So once again, it does not point to an immediate collapse, but what it does point to is a gradually weakening over time. So the second theme that I want to touch on is also technology as a growth engine. And this is where you see AI coming at the forefront for a lot of conversations that we have today. It is a powerful tool and an important growth driver, but it is an uneven one. And so the questions that we get from investors very often is there currently an AI bubble? And so at this stage, we don't think so. It's not yet. Why? Very simply put, earnings growth has broadly matched valuations and has been supported by real spending on things like data centers, semiconductor manufacturing, software services, automation, so on and so forth. And so the market focus is also shifting from excitement to monetization and real business cases. So of course, there remains risks such as overinvestment or misallocation of capital. For example, if many companies or many firms build too many data centers, then there runs the risk of excess data center capacity, which runs the risk of oversupply down the line. But broadly speaking, which I come on to point number 3, this creates some opportunities in other areas out of the US, such as in emerging markets, where oftentimes it is misunderstood. And to help us remember what we should remember when we look at EM equities, then we can look at the 3 C's: carry, capital expenditure, and cheap valuations. Carry. What do I mean by that? Very simply, if you follow the trend of the US dollar weakening, yes, we know that in recent times it has rebounded somewhat, but at the broad speaking fundamental levels, we do see a weakening of the US dollar. It supports EM asset prices, household incomes, consumption, and lower debt servicing costs. Why? Because many of the debt that EM countries take up is in US dollar. And with a weaker US dollar, it means that it is easier to service debt. Moving on to capital expenditure. Once again, when you see the national agenda of reshoring, asking allies to do more defense or doing more transition to clean energy, all these countries in emerging markets are actually spending more in this area. And this is driven by infrastructure investment that you see, manufacturing, transitioning to clean energy, industrial automation, so on and so forth. And these trends are actually reinforced, not weakened by geopolitical conflict, right? It's very straightforward where if your livelihood or your supply chain is being threatened, then obviously what you will want to do is make sure that you're more self-sufficient, or you expand diversified ties with other partners to ensure that your own stability. And lastly, cheap valuations. February, emerging markets really rallied, yet it still trades at a good 30 to 40% discount to the S&P 500. And investor allocations remain near 20-year lows. So expectations of growth really are much higher in the US as compared to emerging markets. And that's why we also see much more opportunity in emerging markets. And no discussion will be complete without looking at China. And once again, just as emerging markets, I have the 3 C's. For China, I have the 3 L's, which is simply low valuation, low positioning, and low expectations. Low valuations, very similar to cheap valuations for emerging markets, where valuations remain depressed, largely due to weak sentiment and falling prices. Low positioning, foreign investor confidence remains low, leaving China underweight versus historical allocation in portfolios. And lastly, low expectations. Despite the rebound in recent years, China still faces real structural headwinds, weak domestic consumption, a prolonged property downturn, deflationary pressures, aging demographics. These are just some that we can name. And this was reflected in the latest 5-year plan, which lowered the growth target to 4.5 to 5% instead of 5 to 5.5%. However, we note that China has strong state support. As much as the confusion is being caused by other major powers, what you see China is very consistent throughout the strong state support. They have the ability to mobilize policy, capital, and many of their other state-owned financial institutions, such as to provide a strong buffer against external shocks. We also see them very in tune and even developing much faster in sectors like tech and AI as well, which is what we also saw in an earlier theme. Furthermore, even with the current conflicts that we see in Iran, we note that it actually has low external dependence, energy dependence. So only 16% of its energy comes from other countries. Most of its internal energy actually comes from domestic coal as well as renewable energy. They also have strategic oil reserves covering over 100 days of imports. And so even then, despite being the world's largest energy consumer, oil and gas only contributes a small share of China's energy mix, so limiting their vulnerability to supply shocks as compared to maybe some other Asian economies. So I just want to encapsulate the current macro environment into just these two themes. And as we put this at the base of what we are sharing, then we look forward to what is our approach for 2026. And with all this volatility that we see, Aberdeen believes in three areas. I've touched a little bit in emerging markets in Asia. There's also credit, but the main focus today is on income strategies, right? We see overall portfolios have become more defensive with a greater emphasis on income and selective allocations. But why income, you might ask, right? Simply, income offers a sense of stability. It provides more consistent and predictable returns that help investors like you and me, or everyone, navigate shifting market conditions with greater confidence, right? These strategies help to dampen portfolio volatility and reduce reliance on purely price appreciation. So this is well suited for investors seeking sustainable and diversified sources of returns. And in the long run, this consistency helps preserve capital and support steady portfolio growth. So the next question then is, where do we look for income generating assets? And there are multiple asset classes across which Aberdeen also has solutions in. For example, in our fixed income range, we also have our Asian Quality Bond Fund, which some of you might have heard before. But one area that you can't overlook is definitely on equity income strategies that provide dividends as well as potential for capital growth. So that actually brings me to the third part of my sharing, which is where I introduce our Global Dynamic Dividend Fund for those of you who have not heard of it. And for those who have heard of it, perhaps this will be a refresher for you as well. So which through this fog of geopolitical conflict, policy uncertainty, technological changes, all unfolding at the same time, this actually still offers opportunities to investors who stay disciplined, selective, and focused on long-term fundamentals, looking for income combined with long-term capital growth. And in case some of you can't stay to the end, let me just give out some of the spoilers by highlighting that this fund, in terms of the income, has just increased its dividend payout by over 14% in the past month. So for those invested in the fund, you will now be receiving 12 cents per unit against the previous 10.5 cents per unit for the Sing Dollar Hedge share class. Okay. So why do we focus so much on dividends? So that's because for long-term investors, dividends play a big role in building returns. And if you look at this slide, you will notice that across key global markets, close to 50% or more of total returns, actually, since 2001, have come from reinvested dividends and not just your price appreciation. And that's what our fund focuses on, investing in high quality companies around the world that generate steady cash flows and pay sustainable dividends. So these dividends that provide a more stable and repeatable source of income helps to dampen portfolio volatility, especially during markets up and down, helping investors to stay invested. So we now know that dividends, yes, are important to total returns. The next question is, are dividends growing? And the answer is a resounding yes. If you look at this slide, from 2018 to 2025, global equities have a long track record of paying dividends. And what you can see here is the quarterly dividend contribution within the MSCI All Country World Index. And even though throughout different market cycles, dividend payments have proven to be resilient and steadily growing. Even when you see 2020, when it's COVID, yes, there was a dip in dividends in second quarter, but you will see it after 1 or 2 years, it has recovered and even overshot its previous marks. And so this alludes that while share prices can fluctuate sharply, companies that remain committed to returning cash to shareholders makes dividends a core driver of your long-term returns. And so we dynamically allocate across regions and sectors, and we hope to be able to capture these dynamic sources of income. And the last part about dividends that I want to touch on is, while dividends have been increasing, we also see that this growth is very broad-based. And over the past year, you can see the MSCI All Country World dividends have grown by about 8.5%. And this growth doesn't come from just any one sector. You can see that it comes from sectors such as financials, industrials, communications, more or less every sector that you can see. So it is really broad-based. And that's where the fund comes in, that we don't just look at any one sector or any one geography. We are able to dynamically rotate to where dividend growth is strongest, while avoiding areas that might come under pressure, so as to deliver that sustainable income and long-term growth over time across different market periods. And the last part will be that this slide just shows that it is very difficult to time markets in terms of the styles of the companies that you own. And this shows that value and growth, they do rotate in terms of performance. And that's why our fund is structured as such. We have 60% value holdings and 40% growth stocks. We mitigate the risk of market timing by maintaining this balanced mix, and that helps our investors benefit from reliable dividends and growth opportunities across different market environments in one globally diversified portfolio. So just to reiterate on income, why now? I've mentioned that income offers a sense of stability during times of market volatility. It helps you to navigate through shifting market conditions with greater confidence and acts as a dampener for portfolio volatility. In the long run, it helps to preserve capital and support steady portfolio growth. So not just that, but we also see that dividend stocks outperform. Historically, companies that pay and grow dividends have historically outperformed over the long term. Second, dividends offer a degree of protection against inflation because high quality companies that we hold are typically able to raise their payouts as prices rise. And lastly, income stocks today still look relatively attractive compared to the broader market. And so this is where the fund really plays and creates a strong backdrop for our fund to operate in. So we recognize that income is important, and we recognize that dividends are important. But how do we decide what strategies to use? So there are many strategies out there. There's no 100% right, no 100% wrong, right? But this just gives a snapshot. You can look at bond funds, credit income bonds. Income potential, usually around 3 to 6%, but stable income stream as well. But what's the trade-off is that in a low rate environment, there's very limited upside potential. High dividend equities tend to be more narrow and cyclical. And if you look at systematic covered call equity strategies, they tend to cap growth by nature of them using derivatives of covered calls. So our fund aims to strike a better balance, providing sustainable income with the flexibility to capture upside through a diversified global equity approach. And we do that without using covered call strategies. So then you might ask me, James, so how does the fund actually work? So at a glance, this slide tells you really a very quick summary of what the fund is. It's managed by a pod, which is made up of Josh, Martin, and Andrew. We have over 2.2 billion in assets. And if you look at the left center box, it's just two-pronged. It's very simple. we have what we call a dividend capture sleeve and a call sleeve. And I'll touch on this a little bit further. Okay. So I've mentioned a lot about delivering a premium and consistent income stream, and this slide really backs it up. And if you don't listen to anything else that I mentioned, I think this slide is something that is worth taking a look at. This shows you the payouts for the last year from April 2025 to March 2026. But if you stretch this table all the way back more to the strategy's inception in 2012, you will find that the strategy has only done two things in terms of dividends. It has either only increased or kept constant its dividend payments. When I mentioned 2012, that is really the US strategy. But correspondingly for the Sing Hatch share class, the Singapore dollar share class, since its inception in 2020, it follows in the same vein as well. So sharp-eyed attendees, if you notice, that just last month, the distribution per share has increased from 10.5 cents to 12 cents. And if you didn't hear what I mentioned earlier, or whatever I mentioned this at the start, the distribution has increased by more than 14%. So two very common questions we receive on this page is, hey, does this fund experience NAV erosion due to its dividends? And the answer is no. In fact, the dividend capture sleeve for this fund has been even more positive towards total returns, and this I'll touch on in further slides. And this means that investors are not compromising total returns in order to receive these dividends. So no, we don't have NAV erosion due to paying out dividends or using this dividend capture sleeve. Secondly, how sustainable is this increase? Because the last thing we want is for a fund to pay out high dividends, but eats into capital, right? It's basically just left pocket into right pocket. What we want is you have both a good income stream as well as capital appreciation. So this increase, I'll consider this. The distribution amount is reviewed every 6 months in March and October. Since 2012, 14 years ago or 28 reviews ago, the review meetings have only had two outcomes, like I mentioned earlier. Number one, it has been keeping distribution amount constant, or number two, it has only increased dividends. So fair to say that as far as possible, we will want to keep this track record intact. So how does it do it? So this dwells more into the fund itself. And it's very straightforward, very simple to understand. It's built around two components. Firstly, a core global equity portfolio. This is really your long-term growth potential and regular dividends. You buy and you hold. And I'll show you in the next slide what I mean by that. And second, a dividend capture sleeves that actively targets additional income from dividend events. This sleeve contributes over 50% of our dividends that we need in order to pay out. So this creates three income streams from this fund to help enhance consistency while remaining flexible and diversified. So what do I mean by dividend events? Basically what the team does, we monitor thousands of companies globally, selectively investing in stocks shortly before dividends are paid, once dividends such as regular, special, or seasonal payouts have been announced, or what you call special opportunities. Once the dividend is received, we then review the position, recycle that capital into the next opportunity, allowing us to repeatedly capture more dividend events across the year. So a graphical representation would look something like this, where we review over 1,000 events globally, and we rotate through about 50 to 80 opportunities a year. If you see the first row, that's really your core portfolio where there's low turnover, about 30%. Then you'll see the second row, which you have known dividend events, which is high turnover, where, as I've mentioned, you enter slightly before the dividend, before the ex-dividend date, and you exit shortly after the payment is done. And of course, the last row you'll see is more opportunistic in nature, in terms of more special, opportunistic special dividends. And to give you an idea of what this looks like in practice, we can then look at how this 5% of a portfolio generates 3% of the yield. Right. So if you assume that the fund has 100 million, starts with 100 million, 95% of this fund is invested into your core holdings, your buy and hold. So this portion of the portfolio gives you about 3% running yield. That makes up about half of your dividend yield that you need. Then the secret sauce comes in, where just 5% of the portfolio allocation, we go into dividend capture trades. And each investment assumes we yield about 6%. And then we further assume that each capture trade, or 1% of the portfolio, let me say 1 million, each trade then generates about 60,000 in income, right? 1 million is the amount that you use to buy. And of this 1 million, you get 6% in terms of the dividend yield. That's how we get 60,000. So if you look at how many events we go through on a yearly basis, we go through maybe on an average about 50 dividend events, you see that this dividend capture sleeves generates about $3 million of income annually, right? 50 events multiplied by 60,000 per event gives you 3 million of income. And so that's how this slide shows you somewhat how it is in practice. So how realistic is that example? If you see on this slide, this shows the exact track record of the team when it comes to this strategy. Over the past 7 years, the team has consistently captured about an average of 61 dividend events each year, each generating an average about 8% dividend yields. And so I would like to also highlight what's important to note is that the trading doesn't come at a cost to the NAV, because some people will then mention, hey, if you consistently do trades like this, there will be trading costs that eats into the returns. That is what the last column is trying to mitigate. In fact, that the trading has added a positive contribution to the fund's total returns as well. So what does this tell us? Number one, the process that the team has done is repeatable. They have been doing it for over 7 years. Number two, dividend capture does not eat or have performance drag, right? It does not eat into your NAV per se. So this shows that the dividend capture sleeve works and gives us confidence that this sleeve can continue to support the fund's objective even after the increase from 10.5 cents to 12 cents per unit. Now, how are we positioned in terms of performance? I think if you have followed through what I mentioned in terms of how the geopolitical landscape is now, with more people looking inward, we see that rather than relying on any one single sector or geographies, we will want to be more diversified in nature. Of course, you still have to be some overweight in certain areas where the broad drivers of returns still majorly come from, for example, the US. But we are more diversified and balanced across both sectors and countries as compared to the benchmark. So if you see our top holdings will be in IT, financials, industrials. In terms of country positions, yes, we also have we are about 58% invested in the US, but you'll see we also have a higher allocation to regions such as Europe, where you see France and Netherlands, as well as Asia as well, right? And it's important to remember this perspective to view the fund, where it is 60% value stocks and 40% growth construction. This fund is designed first and foremost for income delivery, not just capital growth. And that's how the fund is constructed. That is why there has been that consistent dividend payout per unit, which, if you haven't heard it yet, I'd like to just reiterate, has increased by over 14% over the last month. So the focus remains really on providing that stable income stream with the controlled risk, which, yes, it can lead to different performance outcome if you are comparing it to a more growth-oriented benchmark. So to close off, this fund is built with this clear objective: to provide income combined with long-term capital growth. It combines a long-term global equity core with an active dividend capture sleeve, which gives investors exposure to both capital growth and income. To highlight, this portfolio is well diversified across sectors, countries, and styles, not just in any one particular area. And the outcome, we get a premium analyzed yield of about 5 to 7% paid monthly without using covered calls that may cap your upside or rely on unsustainable dividends. So to end off, the takeaway is simple. If your goal is consistent income without sacrificing long-term potential, then this fund is something that you should look at. With that, I think I've come to the end of my sharing. maybe have open the floor to Q&A as well.
Right. Thank you, James, for the wonderful sharing. So we will now open the floor to questions. We'll wait for a few more minutes while people are typing the questions.
Okay, thank you for the questions. I think the first question that I'll see is how much of the percentage of the monthly dividend is coming from capital? The answer is none. It is entirely from natural income. So just to explain a little bit further, 95% of the portfolio is a buy and hold strategy. You get dividends on a quarterly basis. And 5% of that, 5% of the portfolio then goes into the dividend capture sleeve, where we do trading into dividend events on a more regular basis. So 3% comes from the buy and hold core portfolio, while the other 3% comes from the dividend capture. This is just an example of what it looks like. So none of it comes from capital. We don't need to dip into capital or erode NAV for that purpose across the entire year. I hope that answers your question. So actually, if you see, maybe what I'll also allude to is if you look at the fund's launch price, it was at $20 back in 2020. Currently, as of today, it is at $22. So in fact, you have already gotten a percent. If you had bought into the fund, you would have been receiving that monthly dividends. You would also have been seen a 10% growth in your NAV as well. Hope that answers your question. So the next question is, with 58% US focus, is the fund hedged to de-risk the FX risk? Yes, we have a Singapore dollar hedge share class available for subscription in Singapore. The dividend is paid out monthly. And the fund is SRS approved. It is not CPF approved. Right? Okay, I think I've also answered one of the questions, which is what's capital appreciation of the NAV since 2020? Launch price was $20. Last I checked is $22 thereabouts, which was just earlier today. Yeah. Okay. One of the questions is, yes, 95% of the fund is invested into the core portfolio, 5% is into the dividend income sleeve. Yes, it is possible to tweak that to 10%, 20%, so on and so forth. But then what we are lacking there is really giving the time for the core holdings to grow further. And when you do dividend capture, we are also mindful that there will be a downtime to how much of the fund, how much of the amount that you are using is in being invested. So because it is a bit of dividend trading, so there will be a little bit of lag time in that sense. And if you see from my earlier slide, the net gain to the strategy when you're doing dividend strategy, when you're doing this dividend capture, is really quite minimal, like 0 plus 0.1, 0.2 in terms of the NAV contribution to total returns. So we could, but we don't see a need to, because at this current level, it is already generating at 5 to 7% income, while also giving you a very nice balance of that growth element. Yeah, so I hope that actually answers your question as well. Okay, one of the questions asks that the fund lacks the benchmark. So why? Um, just coming back to what I've mentioned earlier as well, is that if you see the benchmark, it is really quite tilted in favor of growth-oriented stocks. Our fund is 60% value stocks, 40% growth. So it is natural that in times when growth stocks do run rampant, our slightly less allocation to such stocks will then have an impact on the total returns. However, what I want to mention then again is, look, this fund, in terms of its objective, it's really generating you that stable and consistent income, which is where this fund really shines, and it has been delivering over the past 5 years for the Singapore share class, or even back to 2012 for the strategy itself. How do we know if dividend is not from capital when we only have access to the fact sheet? Most so-called financial advisors are not equipped to tell us this when asked. It is a good question. If you look at most fact sheets, there will be a disclaimer below that says, yes, there is a possibility that distributions will be paid out from capital. The fund manager retains the discretion to do so. This fund, by its nature, like what I've shown earlier, where the dividend comes from in terms of the illustration, where it is 95% core portfolio, which generates 3% of the running yield, and then the other 3% is generated from the dividend capture sleeve. That's where we can safely say that we don't need to pay out from capital in order to meet the distribution. I am also, I mean, it is an MAS regulation that I cannot say anything that is not factual. So I we do have to make sure that what we are saying is factually correct before we answer the question. Why most advisors are not equipped to tell you that is because it is also quite internal information to us, where that's where the portfolio managers, when you look at the attribution and where the dividends come from, that's where we then have to have the ability to see and to prove this, at which most financial advisors won't have access to this internal system that we have. Yeah, so I hope that uh, assures you on your question. One of the questions is that fund is heavyweight in US, about 60%. In view of current events, any plans to relocate country allocation or any reason that AI is the higher sector allocation? How active is a PM in managing this fund? And how often rebalancing takes place? So the fund has an allocation to US, but as what I've alluded to earlier, if you compare it to the benchmark, we are actually underweight the benchmark in terms of US. So when I say we are diversified, we also have to be aware of where drivers of returns are still coming from. And without fail, the US is still there, right? Regardless of what has been happening, yes, it is a gradual weakening of the US dollar, it is a gradual reshifting from US away from US. At this point of time, US is still a superpower or the main superpower. You most likely still have to have allocation there, but whether you overweight it or underweight it as compared to benchmark is where then you take the tilts, right? And for us, we do underweight the US, but we are actually a little bit more overweight Europe, where there's more value stocks that we hold, which provides good dividends as well. Any reason why AI is a higher sector allocation? It plays back into my second theme of technological growth, where AI is one of the main drivers of returns over the last couple of years. If we didn't have US or AI in our holdings, if you look at some of the stocks around there, it makes up your Max 7, so on and so forth, a lot of drivers of returns have come from these. And if you don't have those, you would have lagged the market. So AI has been the trend. We have been invested into it. And that's how our allocation comes about as well. How active are we in managing this fund? So in terms of dividends, We review it every 6 months, so we make sure it's sustainable, and we do want to keep it sustainable as our track record has been very stellar. Um, they are very closely monitoring market situations, making sure that the holdings that they have are suited for the portfolios. If you look at portfolio turnover, the turnover is about 30% for the core portfolio, which means that the fund stays in for about every year, about 33% of the holdings have some reallocation or rebalancing or buy sell transactions. Um, in terms of the dividend capture, then you're looking at a higher portfolio turnover because of the trades that we do. Therefore, of course, the holdings in the fund gets transacted a lot more. So there's about 80%, right? I hope that answers your question as well. If not, please let me know. I think that also answers the next question is how actively are the core funds reviewed? Um, we are we keep tabs of the markets. We do the analysis. So the pod is also supported by over 100 analysts across the globe to ensure that the thesis of the individual holdings that we hold still remain relevant. And like I mentioned, in terms of portfolio turnover, for the core portfolio, it is about 33% across a year, which means the holdings, about 33% of the holdings get refreshed on a yearly basis. Okay. One of the questions is, can the dividends be reinvested into the fund? Yes. Then you'll be looking at the accumulation share class. And I think IFAS itself or FSM has its own mechanism. That one I will defer to them to maybe respond in a couple of minutes. One of the other questions is for this fund, after it pays out monthly dividends, does the fund value drop? Simply yes, and that's because and that holds true for everything, even our dividend capture, right? Once you receive the dividends, your NAV drops by the same amount, usually. Of course, when we do dividend capture trades, thank you very much for this question. When we do dividend capture trades, we scour the universe for over 1,000, right? There are over thousands of dividends events, but you can see we only go into about 50 to 60 to 70 trades a year. We are very selective. We have to have a fundamentally constructive view of the holdings that we want to buy, such that we would say that even after we collect the dividends, it is likely that the fund will rebound and resume its upward trend in terms of its NAV. That's one of the factors that we will look at when we are doing these dividend capture trades. So why does the fund value seem not to decrease even though it keeps distributing dividends every month? Very good question. That goes back to the dividend capture sleeve and the fact that we do not eat into capital, or we do not need to sell off units or dip into capital to pay out these distributions. So you're still getting that growth from the holdings that you have in the fund while still getting these dividends every month. Right? So I don't know if that sufficiently answers the question. Please let me know if it doesn't. Yeah, because these kind of sustained returns, yes, it has been maintained in terms of the income and not eating into capital in order to pay out the distribution. So the two prongs, right? Two sleeves to this, or two ways, two buckets that you look at. One is your capital appreciation of your holdings. One is the income that you're receiving. Capital appreciation plus your capital growth or your capital depreciation, in whichever case it is, plus your income actually generates you your total returns. That's simply put, that's a picture. Some would use capital in order to fit their distribution. That's why you see NAV depreciating. For this fund, we don't need to, and we do not need to use capital to boost our distribution. So you're getting a higher, better total returns with that sustainable dividend. Okay, and that's really a function of how the portfolio is constructed from both the core portfolio as well as the dividend capture sleeve. Okay. I think they've answered about most of the questions, I believe. Yeah.
Thanks, James. I think we can
Yeah,
take one last question.
can.
Uh, there's the actually hedge fund class. I think so curious question would be like, what is the hedging cost then?
Hmm. Um, Hedging costs for the current moment it is if you're looking at, I mean, okay, I'm drawing this from more from fixed income side of things. We're looking at about 2% hedging costs at the current moment as well. So that's where we would assume that there will be representative of the hedging costs for this. Oh, maybe I see one more question. Compared to US corporate bonds, which fix their yield at about 6%, what's the risk involved for this fund? This fund, it is a 100% equities fund. I've also alluded to earlier that yes, there are another way to get income is also through uh, fixed fixed income solutions, such as our Asian quality bond fund. Uh, just a side note, but what that lacks then is also sometimes the capital appreciation that you might have. And so when you look at this 100% equity fund that we have, you don't just get the income, right? You have that about 6% income around there, but you also have the NAV appreciation as what you see from the launch price, $20, to the current price, $22. So you get that capital appreciation as well. Of course, then you take on additional risk because equities generally tend to be a little bit more volatile as compared to fixed income, right?
All right. And that is the last question that we will take for tonight. So thank you once again, James, for the wonderful sharing tonight. I'm sure we all have learned a thing or two, and also a big thank you to everyone here who is with us this evening. So I hope you find the sharing useful in your investment journey in 2026 and beyond. And of course, we would like to invite everyone here to connect with us. So on the screens are the links to our various social channels. So feel free to scan the QR code of the channel that you use often, and then we will see you there. So we also like to encourage everyone to subscribe to our Telegram channel, whereby we post updates on a daily basis to help you in your investment journey. And with that, the webinar has ended. And have a great evening, everyone. We feel free to leave the room from now onwards, and thank you once again.